Everybody, welcome back to day two of Startup Week Chattanooga with CoLab. I'm Shayn Fernandez, the corporate lead at Rockridge Venture Law. So today we have a very interesting, detailed discussion today about term sheets. Just before we get started, let's do a quick little legal disclaimer here. I'm not your lawyer. This isn't legal advice. Nothing that we discuss today should be construed as legal advice. Yada, yada, yada. Please review the rest of the screen. Keep going, keep going. All right. So today we're going to talk about term sheets. When we're talking about term sheets, we're going to be focusing on early stage investments in emerging companies and startups. And so you might hear these called different names, such as a pre-seed round or a seed round or a friends and family round, but we're here generally talking about the early stage financings. So what is a term sheet and why does it matter? So a term sheet is kind of a starting point of a financing round, and we're talking financing round. We're talking about a company raising capital to scale or really grow its business from outside investors. Usually, these are private angel investors. Sometimes they're wealthy family members or friends of family members or friends of friends of friends of family members, or venture capital companies, venture capitalists, things like that. So we're talking about a term sheet. It's generally going to be a really short um, deck, kind of like this. As some examples. We'll go through this a little bit more in detail, but we're talking about a back of the napkin type of arrangement. It's generally going to be said to be non-binding. There'll be some binding terms, such as like exclusivity. Basically, you can't take this deal and pass it on to somebody else and try to get a better deal. This is going to cover the high level structural points. So the type of securities that are being offered, the pricing terms, evaluation. It's going to include the key economic, non-economic terms, and the whole purpose is to avoid surprises when you draft the ultimate documents. So here's a quick example of one of the types of term sheets that we're going to be talking about here. This is a convertible promissory note term sheet. This is grossly generalized version. And a little bit more sophisticated version would be the preferred stock term sheet. Again, these are just really basic. So let's talk about this picture and kind of what we're discussing today. Let's just say you have a company and you're sick and tired of doing laundry. So you say, hey, Uber's delivering food. They're doing ride sharing. What about laundry? I have a friend who's got a lot of laundry mats at their house and they're staying at home, and why can't I just call them up? They pick up my laundry, they do it and they bring it home. Well, maybe you want to scale that idea to some type of mobile app, and you need to raise money to hire developers and things like that. So let's just frame it in that type of context. So we're talking about raising capital at this stage of a seed stage round or pre-seed stage round. There's three structures that tend to be the most common. You have convertible debt, convertible equity, and then you have price equity, which is preferred stock. So here's an example of a convertible note round to kind of set the stage for what we're looking at. We're talking about convertible note, we're talking about convertible debt. It's basically going to be a promissory note or a promise to pay a debt or to fulfill an obligation. That's going to have a principal and an interest. As you'll see there, it's a minor 2% interest rate. $1 million is a principal balance. And like debt instruments, this is going to have a maturity date. And then we'll talk about the final four little sections in a little bit more detail. So what's the difference between convertible debt and convertible equity? So basically, convertible debt is again, it's debt. It's going to have a principal. It's going to have a minor interest rate, usually around 2 to 4 to 6%. It's going to mature over between 1 and 3 years, sometimes 5. It's generally going to be around 3 years. And then we're talking about convertible equity. It's not necessarily equity, but it's not debt. These are kind of known as safes or KISSes. Simple agreement for future equity. This is kind of known by Y Combinator was the one that came up with that. So there's no principal because it's not debt, and there's no interest, and there's no maturity date because again, it's not debt. Let's go back here to our term sheet. So that's a major difference between convertible debt and convertible equity is the fact that one of them's debt, so it's principal, it has interest. and it has a date that the debt is due. But what these share is they share conversion events, the price you convert it to generally, and some of the conversion terms of getting to that conversion price. So let's take a step back. Let's just pretend like we have debt. We have convertible debt here of $1 million, 2% interest rate. It's going to mature over 3 years. And what causes it to convert to equity? So generally, an investor is going to want to participate in the upside of a company's growth. So they will issue convertible. They'll buy convertible debt, or the company will issue convertible debt. And what that means is that there'll be general payment terms of principal and interest that generally are deferred until maturity. And when the company raises future equity through preferred stock, this is going to be called a next equity financing or a qualified equity financing. If you look at our term sheet there to the right, you'll see it's got a $1 million that defines the next equity financing. So when that happens, the amount due on the note, which would be the principal and the interest that is accrued, will convert to equity based on the price that the equity is purchased at that next round. And so in order to get early stage investors to do that deal, you have to offer some type of discount on the rate that investors are paying in the later round of financing. So that's where we get these terms called the conversion price and the discount in the valuation cap. So again, conversion events, the main one that we talked about was a next equity financing or qualified equity financing. And it basically says, hey, if the company raises equity, preferred stock of this amount, then the debt is automatically going to convert to equity. And it's going to take on the identity of the securities that are issued in that round of financing. There's other ways that a debt can convert, or the price or the non-priced equity can convert, such as a change of control. So like if the company is acquired, our launching company is acquired before the debt is due, then it would convert as well. And that's kind of up to the holder of the debt. They could say, hey, you know what, actually we're just going to get our principal and interest back, and we're not going to convert just based on the pricing that the company was sold for. Or maturity. So at the end of that 3-year period, they might choose to convert that into common stock at the fair market value of the time that it matures. This is a potential trap though, because sometimes what happens is after that 3-year period, if they haven't raised funds, then investors will try to renegotiate the deal. So they'll try to get an even better deal at this point. So you kind of have to be careful about what you do upon maturity. And obviously at that stage, the company probably doesn't have the money to pay off the debt. So conversion pricing terms. So let's go back to what we were just talking about. Now we're talking about giving investors a better deal than the next equity financing investors. So there's 2 ways of doing this. There's a discount, which basically says, hey, if later investors are buying our company at $1 a share, you're going to get a 20% discount. You're going to get it 80 cents a share. Or you have a valuation cap that basically says, hey, look at the pre-money valuation. We're not going to have a valuation that's higher than this. And so the discount's pretty easy. It's just, it's usually between 20 and 30%. And the valuation cap, you have to kind of walk back to the price. You look at the valuation cap, which if you look back at our term sheet, was $5 million. You take that and then you divide that by the fully diluted capitalization. Fully diluted capitalization, we're going to try to make it easy here, but that basically just means all the stock that's issued and outstanding at the time that could be that's set aside to be issued at that time. And so you divide the cap by the fully diluted capitalization to get the valuation price per share. So importantly here, investors do not get to use both the cap and the discount. It's whatever gives the cheaper price per share. So you're talking about cheaper price per share, then you multiply that by the amount that's owed on those notes, and that's how you get what the note converts into, the conversion price. So let's slow it down here and let's go to illustration 1. So let's say we have 4 million shares in capitalization. We've got a valuation from our equity financing round. So this is after we issued convertible notes, and that gives us a valuation of $4 million. And so we know that our next equity price per share that new investors are going to pay is $1 per share. We got 4 million shares at $4 million valuation. And then the terms of our notes had a discount of 20% and a valuation cap of 5 million. So what's interesting there, if you take a look, is the next equity financing valuation is actually lower than the valuation cap. This is often a pretty good indicator of what we're going to see. So let's walk through this. So what's our discount? Our discount on $1 per share would be 80 cents per share. So our convertible note investors would convert at 80 cents per share instead of $1. The valuation cap would result in $1.25 per share. So the investors are going to want to pay the lower price. The note investors are going to want to pay the lower price, so they're going to use the discount instead of the cap. And kind of what we alluded to earlier is the fact that, when the valuation cap is higher than the valuation in the subsequent round, you're going to be using the discount. So problem 2, what happens when the valuation in the next equity financing is more than the valuation cap? So the cap sets a ceiling. Here we have a next equity financing valuation of $10 million. That results in $2.50 per share. You check my math on all these, but that's $2.50 per share. So the discount, what's a discount? It's 20% of that, and the valuation gets to $5 million. So what does that look like in practice? Well, so when we apply the discount to $2.50 per share, and we're going to get a $2 per share. That next equity financing price should have said $2.50 per share, but let's just ignore that. And $2.50 times 80% is going to be $2 per share, so the discount puts us at $2 per share. Now, if we apply the valuation cap, which is the valuation cap of $5 million divided by the fully diluted capitalization, we're going to pay $1.25 a share. So the better deal for the note investors would be to pay $1.25 per share. So that kind of gives you a little bit of an idea of how the cap and the discount work together. And again, the valuation cap is not a valuation because technically you could use the discount, right? Like we did in the first example. So that's kind of important. We'll get to that a little bit later, why that's important. I don't want to get too deep into this here because it's a little bit in the weeds, but I think it's important. So again, the seed round when you're using either convertible debt or convertible equity is basically kicking the can down the road as far as from a valuation standpoint and pricing your equity. But in that subsequent round, when you do raise money, or if you do raise money by preferred stock, you're going to get a valuation. And what investors are going to look for in this round and in the subsequent round, the next equity financing, is they are going to want a preference. If they're getting preferred stocks, they're going to get a preference. And one of those preferences is a liquidation preference. So basically it says, hey, the company gets like a one-time or 1x liquidation preference, which basically means that the company gets their money back first, or they can choose to get their money back first. And so we'll go into this a little bit later. But with one of the issues that comes up is that if you have even just a one-time liquidation preference, the investors in the convertible note round or the convertible equity round aren't paying the full price. They're getting a discount, right? And that's kind of minor. In our first example, it was only a couple cents on the dollar, but it was much bigger in that when we had a bigger valuation. So in order to avoid this, usually companies issue shadow preferred stock or common stock offset, which shadow preferred stock basically means that they'll give them preferred stock to the convertible note investors, but it won't get basically a dollar for dollar liquidation is the same as the others. It'll have the dollars that match the amount that was actually paid. Common stock offset just basically means they'll give them the preferred stock and then they'll offset the remaining that they would get with common stock. Priced equity. So we're on to our second set. If we go back to the beginning, what we were talking about is we had convertible debt, convertible notes, and convertible equity. Here we're talking about just priced equity. This is less common, far less common in an initial financing round than convertible notes or safes. You tend to see this as a Series A, but we're going to talk about what the term sheet would normally see here. We broke this down to economic terms and control and governance terms. Take a look at the term sheet and give you a little bit of a preview. What we're looking at. The security is preferred stock, which is it's stock, but it has some type of preference over common stock. You see the proceeds are relatively the same, $1 million in this situation. The price per share, liquidation preference, voting rights, some things we're going to discuss here. So price to equity, valuation, liquidation preference, anti-dilution, board seats, approval rights, covenants. So valuation, one thing that's kind of tricky in a term sheet that's not always explicit is whether or not the valuation is pre-money or post-money. Basically, that it's important because it's determining whether or not the equity you're going to get accounts for after the sale is over or before the sale is over. Basically, post-money means after the transaction's closed, this is the amount that I own of the company. Price-based anti-dilution. So one term, I don't want to dig too deep into this. It's kind of a lot, but price-based anti-dilution is basically a term that says, hey, we're receiving preferred stock in the event that you sell preferred stock after us that's at a cheaper valuation, then we're going to get some type of recovery from that. So we'll either get full ratchet, which means we'll treat the prior round like it should have been at this new lower round valuation, so those investors get caught back up to speed with the subsequent investors, or there's like a weighted average, which tends to be a little bit more beneficial for the company as opposed to a full ratchet. Liquidation preference. So liquidation preference again is upon the sale or liquidation of the company. It basically says, hey, this is what the investors are guaranteed to get back. Non-participation liquidation preference basically means that the investors can choose to get either their money back, so 1 million or 1 million plus a multiplier, so it might be like 1.5 liquidity preference, or they can get their percentage that they own at the sale. So if it's like 10%, it just depends on which one gives a better deal for them. Our participating liquidation preference means they get both their investment back, the $1 million back, plus they get to participate in their ownership portion of the sale. All right, liquidity preference. Here we have a little example. So they invested $1 million for 20%, sales $4 million. So non-participating, the investor gets to invest, gets the investment back, right? Because 20% of 4 million would be what, 800,000. That's right. Okay. Anyways, just ignore that part. But the non-participating, the investor would get, they're going to choose to get their $1 million investment back instead. Okay. And so the participating, the investor gets a 1 million back first, and then a proportion of the sale of the total. So they get another 600,000. Control terms. Control terms we're talking about in the term sheet. Let's go back again. You might see something along the lines of board of directors, covenants, future rights. We're talking voting rights. We're talking about non-economic terms. So these are things where an investor has some say in how the company's governed, how it's run, certain voting rights. Oops. All right. So investors might want some type of board participation. So they might want to have a board member. On our term sheet, I think we had one. So they get 1 seat out of 3. Where one would be a founder. They usually have 2 founders seats, and then one that's chosen by the majority of the preferred stock. And then you also can see maybe an investor doesn't want to necessarily have a board seat, but they want to have some type of advisory board. So they basically have the right to meet once every quarter to find out what the board's doing, what the company's doing, a way to track their investment. Another control right that investors tend to look for is approval rights. So if you look back at our term sheet there, they have the right to veto any preferred stock issuance. So if they're going to issue stock that has a preference greater than the other preferred stockholders, then they get to veto that. Or if they're going to amend the charter to increase the the authorized shares or issue more shares, and those are things that the preferred investors would get to protect their economic rights, so they have approval rights there. Then you also have covenants, which are basically more operational size of restrictions on the company or promises that the company makes. You see operational IP matters. Go back to our term sheet there. They basically said under covenants, all service providers shall be assigned their rights to relevant IP prior to closing. So one thing you want if you're an investor is to make sure that that the company owns all the IP rights, and it's not owned by the individual founders or by employees. Other operational terms that you tend to see is that they'll require that all employees who are issued stock under a stock plan vest over 4 years, or some type of vesting restrictions or employment terms and things like that. Inspection rights are also something that investors will really push for. They want to be able to see kind of what the financial condition is of the investment and kind of keep track of that sort of thing. Miscellaneous terms. You sometimes will see preemptive rights or rights of first refusal. Basically, that means that the investor wants the right to, if there's a subsequent financing, for them to be offered that right to participate or provide that money in exchange for that equity first. It's sometimes a good thing. Sometimes you might not want to bargain for that if the relationship doesn't really work out. You might not want to have to go to them first. You might want to go to someone else. Most favored nation basically says that you're going to give those investors, you're not going to give other investors a better terms than what you gave your current investors. The don't do it. So sometimes you'll see investors ask for non-dilution, which say like, hey, we want 20% and we always want to maintain 20%. Well, if you're going to have to raise money in the future, you're going to have to probably give up more equity in the future. And so if that investor gets to stay at 20%, then that's going to come out of the founder's end or some other end. It's just going to be a little bit of a nightmare. Mandatory dividends. So this is an interesting term, especially, it's a little bit more common in later financing rounds, but early financing rounds, mandatory dividends, you probably don't really have income at that point or revenue. There's no reason that the money that you're raising in investment should be going right back to the investor in the form of a mandatory dividend. The goal is to eventually, give dividends, but that's once you reach profitability and scale. One of the third terms is redemption or put rights. This is basically the obligation or the right of an investor to sell their shares back to the company at like a multiplier, so they can sell their shares back at any time. This is kind of like mandatory dividend rights. The company probably doesn't have any money other than the investment capital that came in, so it doesn't really make much sense. So I'm sticking around here for some questions. This was pre-recorded, but we're going to stick around with some questions, hopefully not too much on the math side of things. But yeah, if you have any questions, please let us know. We'll be sticking around. I really appreciate your time. Thanks.